Welcome back to the Wall Street Podcast.
Good to be here.
Today, we're taking a deep dive into Goldman Sachs China Securities China Property Weekly Wrap. This one's for week 32, released August 12, 2025.
Right. It's a critical report, really digging into transaction trends, Beijing's latest policy tweaks, and developer valuations.
Exactly. It aims to give you, our listeners, a precise snapshot for making informed decisions.
And it connects those high-level policy shifts directly to what's happening on the ground, which is, quite valuable.
Definitely. Let's start with policy. Beijing recently eased home purchase restrictions, the HPR, but specifically outside the Fifth Ring Road.
That's right, lifting purchase caps for eligible residents there.
What's the immediate impact the report highlights?
Well, this area accounts for roughly 80% of Beijing's new home supply. So the policy is clearly aimed at helping absorb that inventory.
Okay, targeting supply.
Yes. But the report does add a note of caution. The boost to overall demand might remain constrained.
Why is that?
Because the eligibility barriers for non-local buyers haven't changed. They're still in place.
I see. So it helps locals already eligible, but doesn't broaden the buyer pool significantly.
Precisely. And what's significant, and something the report flags as a key watch point, is the potential for synchronized policy easing in other major cities. Think Shanghai, Shenzhen.
Right, whether this is a standalone move or the start of something bigger.
Exactly.
So a targeted easing, maybe not a silver bullet on its own. How is this, in the general market mood, actually playing out in transaction trends? The report suggests things are still, well, softening.
They are, yes. New home sales volume saw a pretty notable decline, down 12% week over week.
And year over year?
Even starker, down 20% year over year. Secondary transactions also fell, though slightly less dramatically, down 3% week over week and 6% year over year.
Okay, consistent declines there.
What's particularly telling, I think, is the sentiment data. Price expectations weakened from both agents. That's down 0.7 percentage points week over week, and homeowners themselves down 0.2 points.
So people on the ground, buyers and sellers, are expecting prices to soften further.
That seems to be the signal, yes.
Although there were some minor counter trends, weren't there? Slight upticks in online activity.
Correct, small ones. New home search activity edged up 1% week over week, and secondary home visitor traffic improved about 3% week over week.
So a little more looking, maybe.
A little more looking, perhaps.
Right.
But when you zoom out to the August month-to-date picture, the actual sales figures remain weak. Primary gross floor area, GFA, sold is down 17% month over month and 18% year over year.
And secondary?
Secondary GFA sold also saw declines, 4% month over month and 2% year over year. So while there might be some latent interest, it's certainly not translating into strong sales yet.
That brings us neatly to inventory and valuations. With sales slowing, what's happening on the supply side, and what does this mean for how developers are valued?
Well, inventory balance ticked up slightly, about 0.2% week over week. Inventory months, basically how long it would take to sell current stock at the current pace, is now at 26.3 months, up from 25.9 in July. So it's taking slightly longer to clear that stock.
And valuations, how are developers trading?
According to the report, offshore coverage developers are trading at an average 34% discount to their estimated end 2025 net asset value, or NAV, and about 0.5 times their 2025 estimated price-to-book ratio.
Okay, significant discounts. What about onshore?
Onshore coverage trades at an average 19% discount to NAV and also around 0.5 times price-to-book.
And the report contextualizes these figures.
It does. It notes these figures are comparable to historical downturn troughs. So, quite depressed levels.
Very interesting. Let's dig a bit deeper into that policy again. What's the really granular impact of Beijing's HPR easing, given it's only outside the Fifth Ring and has those eligibility limits?
What seems crucial here is that it's very specifically targeting inventory in those non-central areas, trying to ease pressure there.
Right.
But it does raise the question, as we touched on, whether the overall market, especially closer to the center, will feel much of a boost as long as that non-local buyer barrier remains firm. The report sort of implies we need to wait and see if other Tier 1 cities follow suit with broader easing to really shift the overall demand picture.
It really does sound like a targeted intervention, not a broad stimulus. Okay, second point. How do we reconcile those declining sales volumes with the slight upticks in search activity and visitor traffic? Are these mixed signals, or is there a clearer narrative?
Well, if you connect the dots, it suggests a market where perhaps the underlying interest or need for property hasn't vanished entirely. People are still looking.
But not buying.
But not committing to purchases at current levels. Exactly. And the key takeaway, I think, remains that negative price expectation signal from both sellers and agents. That seems to be the dominant sentiment.
So the interest is there, but it's cautious, waiting for prices to potentially adjust further.
That seems to be the interpretation, yes. Despite minor activity improvements, the overall transactional weakness and negative price outlook dominate.
Okay, Module 3, valuations. With developers trading at these downturn trough levels, what does the report imply for your investment strategy in China's property sector? Is there value here?
Well, these substantial discounts to NAV and those low PD ratios, especially when benchmarked against past downturns, certainly suggest that value could exist for investors with a longer-term view.
But there's a but.
There is. The report implicitly cautions that actually realizing this value isn't straightforward. It hinges quite heavily on careful timing and critically on the efficacy of continued policy support. Will policy actually succeed in driving a genuine sector recovery?
So it's potentially a value play, but one with significant policy dependencies and timing risks.
Exactly. It requires discerning analysis, not just looking at the low multiples.
Moving beyond the financial markets for a moment, how do these trends, the policy tweaks, the soft sales, the valuation pressures, actually touch the average citizen?
Well, they have a direct impact. The softening market influences how people perceive their own wealth, especially if property is a major component. It affects big decisions.
Like buying a first home or upgrading.
Absolutely. Those decisions become much more complex. While the policy adjustments are trying to stabilize things, these mixed signals, weak sales but low valuations, targeted easing but still, restrictions mean individuals face ongoing uncertainty about asset values.
So it impacts confidence, savings plans, maybe even retirement outlooks.
It potentially touches all of those things, yes.
Yeah.
Uncertainty about future housing availability and cost is also a factor.
It really underscores how intertwined the property market is with broader economic sentiment and personal finance.
Indeed. Understanding these dynamics requires really constant and quite precise analysis. You have to track both the policy moves and the granular data, recognizing how even small shifts can ripple outwards.
This deep dive into the Goldman Sachs report definitely highlights that navigating China's property sector right now demands close attention to every policy nuance and real-time market shift. The fundamental question for you, the listener, remains. With valuations near historical lows but market sentiment still quite fragile, when does that apparent value truly become an actionable opportunity?
Key question.
We encourage you to keep analyzing these developments as you shape your own strategic decisions. Thanks for tuning in.